The market sell-off continuing this week as investors anxiously await Nvidia's earnings. And of course, we have a delayed US jobs report coming out later this week. So AI seems to be something of a cloud over the markets right now. This is interesting, though. Our guest says the US economy would be in a recession this year if it wasn't for all that massive AI investment. We're joined by Colin Graham, head of multi-asset strategies and co-head of sustainable multi-asset solutions at Robeco. Thank you very much indeed for joining us, Colin.
Good morning. How are you doing?
Very good. That's an interesting thesis. The AI investment has been so big that it's kept US GDP positive.
Yeah, I think this is the story over the last couple of years where you've really seen that you've got this two-speed economy where if you look at the NASDAQ, it's done very well. If you look at the Russell 2000, it's done okay, but not as well as the rest of the US market. So you are seeing this two-speed. I mean, some economists call it a K-shaped economy, but yeah, we see this bifurcation in the economy where earnings would have been in a recession last year if it hadn't been for the Magnificent Seven.
I mean, is that okay to have just one pillar of the economy doing well while the rest is lackluster or even declining?
It depends where you sit in the economy, and if you're an investor, then you're investing in the index. You're not necessarily investing in the economy. From our perspective, these companies have delivered their earnings and have supported the valuation multiples that they've been on. And so at the moment, we see this as being a natural pullback in a bull market here. However, once we see the Nvidia earnings tomorrow, and it's more about the reaction to the numbers that will give us more insight as to the direction of the equity markets. But I think it will also give us an idea of the direction for US interest rates and indeed the US dollar.
Nvidia presumably will come out and beat the drum for AI, rah, say the massive spending will go on. Do you think investors are becoming a bit skeptical, though?
I think the market's telling you that. We can't get good sense on the volumes that are going through here because where are people, where are investors, retail money likely to come and say, oh yes, is it 180? Is it 175? Is it 170? Is that the level I'm willing to repurchase my Nvidia stock? And we don't know. We can see that the market can gap down, as we saw in April, without anything going through the market. So from that perspective, it's very important to really understand the market reaction to Nvidia and whether they think that. And on the other side of that, we've seen increased issuance in the debt market for these companies who don't necessarily need to come because they have big cash holdings on their balance sheet. So again, this is another area we're watching, saying, why are they trying to get their weighted average cost of capital down? Is this some way of sort of improving the balance sheet, making the balance sheet more efficient? We know when we look at the underlying data that the promises around data centers and processing power, they haven't given enough capex in order to deliver that. So we know there has to be some other flow coming back into the AI ecosystem rather than just the announcements we've seen.
Actually, let me ask you about British policy. Britain, like so many other countries, wants to be an AI superpower. Is that a national worry that this thing is just going to be centered in China and America, and that Britain, even though it has a great tradition of computing, will be an also-ran?
I think it's all to do with the capital markets and the policies that have been put in place from there, because we can see that this bipolar world, and if you look back at our 5-year expected returns, our flagship publication last year and the year before, we talked about this bipolar world between the two spheres of influence, China and the US, and the sort of the AI and the technology side is definitely one of those bellwethers around how the two ecosystems are trying to diverge, if you like, from the current model. So yes, so from that perspective, I think China and the US are going to lead, but it also provides opportunities for other countries to get involved because you can then trade with both sides from that perspective. So yes, it's difficult for those countries that are caught in between, but there is a path to prosperity there.
Go down the middle. That's interesting. Now, just to get back to the U.S. economy, you reckon it is running hot enough so that if there's stimulus from Trump's government via the big beautiful bill, it risks overheating activity, and of course that tends to bring up interest rates again.
Yes, and I think this is where you're seeing, I think the major trade that all fixed income managers have on at the moment is the curve steepener. So this is where you expect long yields to go up and short yields to come down. So, and that is effectively where we are. And we think that if that happens and interest rates come down with the tax cuts that are promised for next year, then this is going to really put a high pressure economy in place in the US. And usually when you see this, there's other mechanisms that can release the pressure. So in previous times, previous cycles in the 90s and the 2000s, the US imported deflation from China. But with the trade concerns at the moment, that isn't necessarily going to be a channel that will help relieve the inflationary pressure within the US. You're also seeing the reduction in immigration. So you're seeing wages still growing at 4%, according to the Atlanta Fed. Admittedly, that's a couple of months out of date. But yeah, that's still above inflation at 3%. So from that perspective, the consumer looks okay if you have a job. And so that's why everybody's focused on the job numbers, and it gives room for the Fed to cut further. So yes, this is going to cause stimulus to go into the economy without the usual outlets to keep inflation lower. So our view, and we've just launched our one-year outlook, is that actually you are going to see inflationary pressures come back in the US.
You have a thought for us here. You're watching the Vietnamese economy. Vietnam, of course, has been getting a lot of spillover investment from China, but it's a lower cost-based country. What draws you to Vietnam, though, broadly?
Yeah, look, Vietnam is for our emerging markets, equity investors and bond investors. They look at this and see a very good story. So we're in the multi-asset, global, top-down macro. So we sort of leave that to them to decide. But then we look at that and go, actually, there is a really good story here. I think the continuation of the outsourcing, to lower cost areas. And I don't know if you've been to Vietnam, but I've been recently, and it's night and day compared to where it was 20 years ago in Vietnam. So yes, there is growth there. Yes, there's manufacturing, but there's always this overhang of does US trade policy change in order to say, well, actually, you're part of the China ecosystem for exporting goods. Therefore, you should think about should the tariffs also apply to Vietnam at a higher level?
A big population, north of 100 million. We just showed a VanEck Vietnam ETF. I know you're not talking about that, but certainly it just illustrates how there's been money going into Vietnamese stocks over the past while. Thank you very much, Colin. That was great.
Thank you very much, Andy.
Colin Graham, head of multi-asset strategies and co-head of sustainable multi-asset solutions at Robeco.